in the Cleveland chapter. Joining me tonight as speakers are Chris Analazar and John Heston. And for those of you who attended the first session 2 weeks ago, we talked a lot about the basics of some financial management and some ideas on that you can build on to improve your profitability. This session is going to look at strategies and tactics that you can use in your business on a regular basis to improve profitability or maintain it. And so with that, I'm going to turn the session over to John, who will start. And John, take it away.
Okay, thank you, Richard. And before we get into our actual session, as we did in the last one, we're going to have a few slides about SCORE Cleveland. And as we said last week, SCORE is a national nonprofit organization affiliated with the U.S. Small Business Administration, been around a long time. And one of the things we volunteer to do the most is mentoring. And so this slide basically addresses mentoring. It's really where we spend our time, what we do. We sit down, we talk with people who are either in business, like to start a business. We listen to what their goals are, help them find resources, and as they map out their plans, we meet as often as people like, and for as long as they like, and try to, at each step of the process, help them find the resources to the sounding board and the resources to keep advancing toward their own dreams. So we're good listeners. As with last time, we do have a mission, vision, and values like any organization does, and it is very focused on small businesses and giving people the support they need to succeed in small business. And the last bullet in here is very important. Small business is a huge contributor to employment in the country, to the nation's economy, and as divided as we all are as a nation on just about everything else, one thing virtually everybody agrees on is small businesses are important and they deserve to be supported. And that's why we're here. We are focused on groups that people who may not have gotten the kind of support they needed in the past. So we have a lot of material for groups of entrepreneurs, such as Black and Hispanic entrepreneurs, veterans, and women. So we do have on our library, we have a lot of resources that are for everybody. We have a lot of things that are aimed at particular groups too. So this is a picture of the SCORE Cleveland website, and from this website you can find everything we have to offer. We have the local workshops, national workshops are up at the under business training, mentoring. You can actually nationally you can find a mentor. You can actually go to local mentors, see pictures and profiles of every one of us in the SCORE Cleveland. So, and of course, we have under business training. There's a wonderful. It used to be called the SCORE Library, but there are resources for businesses under that. You can filter hundreds of resources down to things that you are interested in, that you need at the time. So now we're going to go on into the content of the presentation. As Richard said, last week we focused on the basics of finance. And as we said last week, we're part of a team that developed this. We were asked to develop a course on finance, didn't focus on the niceties and the conventions of accounting, textbook accounting, but instead presented the basics, concepts of accounting, and then talked about practical uses of them, how you can use that data to help make decisions and improve your profitability. So we're going to continue in that vein this week. We're going to do three things tonight. The first one is we're going to review some very simple financial statements and look for insights. And if you remember last week, we talked about, after we talked about the basics, we talked about some of the basic kinds of financial statements. So we're going to be looking at profit and loss statements and cash flow statements. And we're going to actually do these for Puzzle Mania and Lulu's Beauty Salon. And we're going to, we're going to strip them down to their basics because real financial data can be an eye test. It's a little hard to show on slides. We strip them down to their basics, show some concepts, and it's amazing how much you can learn about a business even with stripped down information like that. After that, because marketplaces change with time, no marketplace is ever static, we're going to do just what we said we would do and go through some examples of changes that can happen in the market, both good and bad, and give you some time to discuss how you can use your financial data to using those examples to make good business decisions to cope with whatever changes the marketplace brings your way. And then finally, we're going to open up the microphones and the chat box. And it's your turn. We'd like to hear from you. Have you run across any of the issues that we discussed? If you've got any insights that you've learned from your business you'd like to share? So we'll just leave that as an open discussion and see where the trail leads. I expect every one of you has more experience than we have. So we'd really like to hear from you. So this is a stripped down cash flow statement for Puzzle Mania. Remember the puzzle company? And it's not too different from a real cash flow statement. And very simply, this is in its simplest form. I didn't break it out. Basically, took the beginning balance for a month. In this case, in January, let's say the business started on the 1st of January with $5,000 in the till or in the bank account. Took in $40,312, spent $21,070, and then you add the cash in, subtract the cash out. Remember, money in, money out from last week, and that gives you $24,242. You take that up to the beginning of February as your beginning balance. Then you add the cash in, subtract the cash. Yeah, subtract the cash out. You get a new total, 34,857, and so on for March. So this is very simple. A real cash flow statement looks much like this. You've got the beginning balance. You've got cash in, which is in a real one it may be divided, but it's not divided a lot. If you've got a business where you let your customers pay after they receive the goods or services, you might divide your cash in into things that you sell cash on the barrelhead and in money that you receive from sales in prior months. And again, it's not when the sale happens, it's when the cash hits your account. So you might divide that up into a couple of categories. Cash in. Cash out in a typical cash flow statement does have some more things are divided up. And the format that I've seen has been kind of three different kinds of expenses. What they call investing, and that is buying inventory for a company or buying equipment or something like that. Basically buying goods, operating on a day-to-day basis. And then what the financing activities, and that's your payments on your loan, both principal and interest. So sometimes you'll see those divided out by those kinds of activities. But a cash flow statement isn't divided up that much. In the beginning of it, isn't all that different from a real one. But we didn't put all those categories in because it would have made this really hard to see. So that's basically how it's laid out. And remember, a cash flow statement, its purpose is to help you to capture what your checkbook looks like and then be able to forecast. Remember, financial and managerial accounting, you capture your numbers and then you look into the future and try to project. So some of the questions we ask is this business seasonal? And one place to look is down here on those ending balances. So you can see that the balances are going up. Companies doing well. They're growing every month. But then you start seeing it dip a little bit. And suddenly in July, you start seeing it go down. August, September, it's down to $234. That's a little slim. Then it starts building up again, maybe because they sell more puzzles over the holidays, but they got to spend a lot of money making them over the summer. So that could be. And so if you look at the cash in and cash out, you see every month the cash in is greater than the cash out until you get to July. Suddenly there's not much money coming in. Nobody's buying puzzles in July. But you're having to spend a lot of money to make them up for the holidays. Continues August and September. Finally, in October, you're starting to sell some goods. Then you start seeing the balances increase. So that's so based on that, it looks pretty apparent. Made it apparent. So yeah, this is a seasonal business. So So you can see the lean months here. And how might an owner, and you can throw this into the chat box and we can talk about it later on. Any thoughts you have? How would an owner deal with cyclical thing? Because in September, if we'll call the owner of Puzzle Mania Fred, if Fred suddenly has an unexpected expense that eats up more than this $234 and he can't make payroll, he could be in deep trouble. So how might Fred deal with this? Any thoughts? Throw them in the chat box and talk about them later. Now, the other type of financial statement we talked about last time was the profit and loss statement or income statement. Again, we've grossly simplified this. So when the question here is how it differs from the cash flow data. Basically, here you can see the revenue is broken out by 3 different products. So you've got it's just like a real profit and loss statement, and then that's added up. And then you've got your variable expenses. Remember we talked about fixed and variable expenses. Well, variable expenses are those that vary with the number that you sell. So for each of these types, you can see what the variable expenses were during the year, and then that's totaled up. And then the gross margin is simply the revenue minus the variable expenses. It's kind of that's your first step in figuring your profit. Then you got to subtract your fixed expenses, the ones that stay pretty much the same regardless of your sales. Then you end up with a profit. One thing you probably notice a difference is that this one, usually a profit loss statement is monthly or quarterly. It could be done quarterly. It's hardly ever do you see one that's done just by the year. But again, to show some out years, talk about forecasting methods, you wouldn't have been able to see the numbers on the chart. So we grossly simplified it. And actually, the first parts of this, down to the fixed expenses, look pretty much like a real profit and loss statement. But those fixed expenses tended to be broken out into a lot of different kinds of categories. So all those things, the rent, the utilities, the insurances, the legal costs, the accounting fees, taxes, all are broken out in a real profit loss statement, and then the profit is the bottom line. So that's and then more refinements to that. Again, unlike cash flow, when the money hits, can be figured differently. We're not going to go into those niceties, but basically, like I said, down to the fixed expenses, it doesn't look too unlike a real profit and loss statement. But again, we condensed it up just so you can get the idea. So question is, did the company make a profit the first year? And if you run through the numbers, you can see if they took in $360, spent $176 in variable costs to make the puzzles, and that leaves them a margin of $183,600, and then subtract out the fixed expenses that go on and on pretty much the same, you end up with $74,760. So it's a profit, and you can see we put in the percentages. That's a 21% profit. It's about what I think it was in the examples last week or last session. So pretty good. So what product brought in the most revenue the first year? And again, you look at the revenue, and obviously the 1,000-piece puzzle brought in the most revenue. Which one's most profitable? Here, it's not broken out. Again, if I'd done that, it would have probably made this an eye test. However, if you individually subtract for each size range, you subtract the revenue and then subtract out the variable expenses, you end up with for the 200-piece puzzle, it's some $64,650. For the 1,000-piece, it's $65,300. And the 2,000-piece, it's $53,650. So you could easily enough do the math. If you're checking gross margins by product, you can either build it into a spreadsheet, or if you only check it occasionally, you can just do it on a calculator. But basically, that shows that the 1,000-piece puzzle is the most profitable. It's got the highest gross margin of all those. So it's both the biggest revenue one, and it's also the most profitable. It doesn't have to be that way. You could have something that brings in a lot of revenue and costs a lot, isn't the most profitable. So those two things don't necessarily run together. So another question, you see that we list numbers and percentages, and then we show the out years. Let's assume that this is the real data, and we're projecting. You notice the percentages are the same, but the numbers are different. And if you do the math, you're going to find that this was built with a 10% increase. So everything was just increased 10% every year. Now that's one way for a very stable marketplace, and the industry is growing steadily, and locally everything you see is steady, and you're not changing anything. You're not changing your prices or your marketing methods. This is one way to do it. If, on the other hand, you do something more nuanced in the way of projecting for the out years, let's say you decide that you want to make more profit by maybe marketing the 1,000-piece puzzles a little more vigorously, or maybe you can find a way to cut your costs on your 2,000-piece ones, or come up with a marketing plan to make it a personal challenge for people to do harder puzzles. You might be able to change these, and if you can project these differently. In that case, these percentages are going to tell you something, because as you project, you change your marketing method, your pricing structure, anticipated changes on marketplace, these percentages will change in the out years. And while the numbers, it's a little hard to see the numbers and see how they change, the percentages are a good indicator of the relative change. So the percentages are useful in that, even though they're identical in this particular one. But that's the profit and loss. Now let's go over to the service side instead of the product side, and Lulus Beauty Salon, which we talked about. Again, the cash flow statement is starting with, again, just for simplicity, $5,000. And the shop brought in $55,000 in January, spent $40,000, ended up with a balance of $19,318. Carry that off to February, add the cash in, subtract the cash out, got a new balance. And if you look at the trend, it doesn't look like there's any seasonal variation other than straight up all the time. I mean, the business is clearly growing very vigorously in terms of cash flow. Lulu probably doesn't need a big cash reserve in this situation. However, there's always things waiting in the wings, and I expect that things can happen. We'll talk about that a little bit later, what could happen. Now, on the profit and loss side, again, we kept it very simple. We just used three basic products: shampooing, coloring, and other. And we captured the revenues for those, totaled it, captured the variable expenses, and summed those up. And this is also known as the cost of goods sold, or COGS, in accounting. And then we subtracted the variable expenses from the revenue and got a gross margin of $267,550. And again, if you broke that out, you get a little clearer picture of relatively how profitable each is. So basically, in terms of the most revenue, it's pretty easy to see that the coloring brought in a lot more revenue than anything else. What costs the least to provide? And the smallest cost is the shampooing. And again, the percentages, as we talked about, I think we did a 10% on this one as well. But again, if you're doing more nuanced forecasting, then those changes, and you run the numbers, those changes in the percentages are going to give you a little bit of insight into how things are changing, what kind of trends, and whether that is indeed what you're seeing. So that the percentages then give you kind of a sanity check. How would you, and you throw this in the chat box too, if you were Lulu and you wanted to increase profit, what might you do? Any thoughts on there? Throw them in the chat box. We can talk about those later. That other category is awfully big. One of the things Lulu might want to consider breaking that out into some of the biggest pieces. There might be some really profitable services buried in among all the miscellaneous stuff. So that's always a possibility. Examine with any data. The more finely break it out, the more time and money it takes to track it. But on the other hand, there could be rich rewards for doing it. One has to make the decision: how finely do you want to break out the numbers? So yeah, throw your thoughts into the chat box. talk about that later. So as we said, marketplaces are rarely smooth and easy, and trees don't grow to the sky, and even Lulu's increasing number could be subject to change without notice. So we're going to go into, Chris and Rich are going to go into things that might be different, either for better or for worse, and then give you some examples, run a few numbers, and kind of open up some discussion for how the owners of the business might respond to these conditions. So again, think about this in terms of your own financial data and how you would deal with these kinds of things. So Chris, it's over to you.
Great. Thank you so much, John. So we are going to look at a variety of scenarios that businesses are faced with choices, and we can actually use data from our sales and numbers and profit margins to help us make decisions about advertising opportunities, discounts, and a variety of other things. So we're going to look at our data and we're going to let it help make decisions for us. Next slide, please. So those of you who are with us, Lulu's Salon, we went over their fixed and variable expenses. We went over their profit margin. John has gone through a bit of their cash flow. At the end of the day, Lulu's Salon has been doing very well and running profitably for the last 6 years. So now Lulu is considering things are going really well. Everyone is, knows what they're doing. It's going smoothly. Might this be a good time to open a second location? So we're going to look at some of her numbers and see if this can help us decide, is it a good idea for her to open another location? So as we saw from the first part of this series, Lulu has quite a bit of overhead, but she has a robust business. She's doing a lot of services. She has fixed expenses of a little over $11,000 a month, and her variable expenses are 60%. So because she's such a busy salon, she's doing roughly 18 clients a day, 6 days a week at an average service cost of $120. So her gross sales, her revenue per month is roughly $55,728. So her profit after you deduct all of her fixed and variable expenses is a very healthy $10,871 a month. So Lulu's thinking, I'm living well. This is a good profit margin for me. Would I make double the money if I opened another location? She would really feel very, very comfortable if she was making over $20,000 profit a month. But there are some things to consider that aren't factored into these original fixed and variable expenses. So one of the things that we did not account for, and many business owners do not account for, is Lulu's time that she puts into the business. So right now, her expenses are $44,857 based on that volume of sales. She has $55,000 in revenue. She's got roughly $44,800 in expenses. So as we saw from before, it's a healthy 20% profit margin. But if we look at her time, she puts in roughly 55 hours a week. If she would have to pay a manager, she thinks she can get someone for give or take about $35 an hour. If we multiply 55 hours times 4.3 weeks in the month, times $35, she would be paying someone roughly a little over $8,000 a month to have a manager. She could not work over 100 hours a week, that would be crazy. And she, it would have to overlap, and that would just not be a fun thing to do at all. So if she paid a manager, what is she actually looking at profit margin? So now she has taken her expenses that were $44,857. They've increased to $53,135. So if we subtract $53,135 from, let's just assume she could have another very busy, nice salon, she's really only left with $2,593. So in her first store, with her being the manager and working all those hours, she was taking home almost $11,000 a month. If she opens a second store, she's whittling away her profit margin down to 5%. And you might say that's not bad. She's still going to be making now over $13,000 if we combine these, and she has the two stores. But you really have to figure there's going to be some added time, some added stress, definitely lots of added responsibility and liability for taking on a second salon. So, as you look at these numbers, you might say it's not worth the extra stress. You might say it is worth the extra stress, but at least you know what to expect, and you're not thinking, I'm going to open another store and double my money, because realistically, you do have to account for a manager at the second store. Okay, next slide. So coupons, people love coupons. Store owners seem to want to offer coupons. It seems like a good way to increase business. And what looks very minor, like 20%, may have a bigger impact on your bottom line than you realize. So we're going to look at some scenarios about what it's like to sell product without a coupon and your bottom line. And then if we just introduce, it's not a huge discount. There are 30, 40, 50% discounts on things. So we're only talking about a relatively modest 20% discount, but it can have a big impact. So let's take a look at that. The first example we're going to look at is, let's say Lulus is selling hair product. It could be shampoo, conditioner, lotion, whatever she's selling. This standard in retail is called Keystone Markup, and that is whatever a product costs wholesale, usually you double it for the retail price. So Lulu's buying shampoo, let's say, at $10 wholesale per bottle, and she's selling it for double what she pays for it, $20. That's very, very standard in retail. So if we subtract $10 is her cost from the $20 sales price retail of the bottle of shampoo, she's left with $10 gross profit per bottle. If she sells 100 bottles at $20 a bottle, she's going to look at $2,000 of sales. We know that she's spending $10 per bottle. So if we multiply the $10 of profit per bottle times the 100 bottles that she's selling, she's going to have a gross profit of $1,000. If we then divide $1,000 of profit by the $2,000 into the sales that she had, she's looking at a 50% gross profit margin. She spent $1,000. She was able to sell that $1,000 for $2,000. So she basically doubled her money. Next slide. So if we want to offer, for some reason, a 20% coupon off of the same bottles of shampoo, what is this going to do to our bottom line? The cost per bottle stays the same. That doesn't change at all. The cost per bottle is still $10. But if we take 20% off, it actually takes a full 40% off of our profits because we're taking 20% off of the retail price. So 20% of $20 is $4 that we're taking off of each bottle. She only had $10 profit. So if we subtract that $4 from our profit, we're left with $16 per bottle, only gives us $6 of profit per jar. So again, the cost of the bottle stayed the same. We offered what looked like a small discount, but it really had a big impact in her profit margin. So all of a sudden, selling the same 100 bottles that brought her $2,000 of sales now only brings her $1,600 of sales. The same 100 bottles that brought her $1,000 of profit is now bringing her $600 of profit. So if we divide the profit, $600, into her total sales of $1,600, we're looking at a profit margin of 37.5%. So you might wonder, well, how do we get that profit back? We need to obviously sell more bottles because our profit margin has dropped down now. So what do we have to sell? If we sell 100 bottles at the regular price of $20, that's $2,000. We have $1,000 in profit. Now we've dropped down to selling the same 100 bottles at $16. That comes out to $1,600 in sales and $600 of profit. So if we want to see what do we have to sell, if we divide the $1,000 of original profit that we still want to get by $6 per bottle, we now have to sell 167 bottles to make the same profit we made off of selling the 100 bottles with no discount. So 167 bottles with a 20% off coupon to make the same profit as 100 bottles with no coupon. So one of the issues to think about is not just that you're making less money. Lulu was able to invest $1,000 to make $1,000. Now she has to buy 167 bottles. So she's going to be spending almost $1,700 to make that same profit because she has to inventory so much more shampoo. She has to sell so many more bottles of shampoo. So again, there are times that you will want to offer coupons for things, but you should absolutely do it strategically when it works for you. So maybe sometimes suppliers are offering specials, and you can pass that on to the customer, and during certain times of year, you can make up in volume what you would be selling normally. Another time is if you know that your inventory is getting a little bit old and you really want to freshen it up and turn your inventory, it also might be a nice time to offer a sale, clear things out, get some fresh new inventory in, and that it works for you. So I'm certainly not saying that there's not a time to use coupons, but you really want to be strategic. You want to do it at certain times of the year. You want to do it when it serves you more than just offering a random discount on something. So it really impacts the money you need to invest in inventory, and it impacts the amount of, you have to do so much more work to sell all those bottles to make the same profits. Okay, so we are going to now ask ourselves the same kind of question, but instead of a coupon, we're going to say, how do we know, is it worth advertising in a certain magazine or online, or how do we know if we want to spend money? And if so, how do we set a budget, and how do we know how well that money is working for us? So it's really important, as we discussed in the first segment of this series, to know how to calculate your profit margin. You need to know what your general profit margin is to have an idea of what your return on your investment is for advertising. It's generally referred to as your ROI, return on investment. So we're going to jump back to Puzzle Mania, and we are going to look at their average monthly revenue of $30,000, and they have a 21% profit margin. They have an opportunity to place an ad for $2,200, and that's going to bring in $14,000 of new sales. Now, we all know in reality, we don't exactly know what revenue an ad is going to bring in, but we can guesstimate, and a lot of times there's some statistics around that. So let's assume we're going to spend $2,200, we're going to get $14,000 of sales, but we don't look at that. You don't subtract 2,200 from 14,000 and say, well, wow, we made a lot of money on that return on our investment. We have to look at our profit margin from that $14,000 and then subtract our cost of that ad. So the $14,000 in new sales that we got from the ad, we're going to multiply by 0.21. That's our 21% profit margin. That gives us a profit of $2,940 before the ad expense. That's 21% of $14,000. We're then going to take that profit, $2,940, and we're going to subtract our ad costs, which was $2,200. That's going to leave us a profit of $740 after our ad expense. So we are going to be not losing, but we're going to be selling 700 puzzles from our inventory. If we divide 14,000 and our cost of a puzzle is $20 a puzzle, we're going to be going through 700 puzzles. And if we look at our profit margin of $740 and we divide by $14,000 of how much sales we had, we're looking at a profit margin of 5%. So another 5% profit margin is certainly less money than our normal 21% profit margin, but we had to place an ad to get that added sales. So calculating the ROI, the return on the investment, is done by taking your gains, or how much extra profit you had. In our case, it's $2,940. You subtract the investment cost, $2,200, and then you divide by that same investment cost of $2,200. That tells us our return on our investment is 34%. So we have $740 increase of profit, that we have our profit margin of 21% minus the ad cost. So you can look at this and say, it's worth it, it's not worth it. But the important thing as you're going into doing ads or anything like this is to make an educated decision based on real numbers about what your expectations are, how much inventory you're going to go through. Is this the right time to advertise? Does it service your business in some way, shape, or form beyond the profit? Maybe this is such a good opportunity that it's going to open up new markets, so you're not so concerned about this particular time and ad because you think it's going to lead to new customers that will have, more sales out of it than just this ad. So there's a lot of things to think about, but it is a really good place to start of how does this impact your bottom line, and is it really going to put more money in your pocket? So now we're going to look at the exact same scenario. The only thing that changed is the cost of the ad went up very modestly. It went from $2,200 to $2,500. Excuse me. That may seem like a very small change, and in the scope of thousands of dollars of sales, it is a small change, but holy smokes, let's see what this does to all of our numbers. So it's really the same calculations, 14,000 in sales, but now our ad costs $2,500. So when we subtract $2,500 from our profit of $2,940, we're left with only $440 of profit after the ad expense. So we sold $14,000 in puzzles, 700 puzzles were sold, and we ended up with extra profit in our pocket of $440. That's a lot of work. It's a lot of puzzles. It's a lot of inventory. And again, there are times where this might be a good decision, but let's, look at a little bit more of our data. If we divide $440 of profit by our $14,000 of sales, we've got a 3% profit margin. So what I think of when I look at a 3% profit margin, what if we only sold $12,000 of puzzles? What if we barely even cover it, or we could end up losing money with such a tight profit margin? It just gets like a slimmer and slimmer chance that I think this is a good idea when we see our profit margin shrinking down like that. The return on the investment is the same calculation as before, but with a higher investment cost. So it's 2,940 minus 2,500 divided by 2,500 gives us an 18% return on investment. So again, we have placed an ad. We've gone through a lot of work. We've had a not insignificant outlay of money of $2,500 for the ad. We burned through 700 puzzles in our inventory. And what we're left with at the end of all that is $440 of profit. So again, there's times to do this. I'm not saying that advertising is not good. Sometimes you have to have some losses to promote your product and let people know you exist and see things are out there. Or again, you might have inventory that's getting old or dated or some kind of something, and you really aren't concerned so much with your profit margin. You really just want to turn your inventory or even get rid of it. So there are times to do this, and there are times probably not to do it. And I think that brings us to Richard to talk about more strategies to improve profitability.
Thank you, Chris. Okay, let's talk about some additional things that you can think about on a daily basis to improve your profitability. First of all, provide your discounts or other perks to your best customers. And let me give you an example. My background is the hospitality industry. I worked in hotels and restaurants all my professional life. And when somebody would come into my hotel and they would say, I'm going to guarantee you a certain number of guest rooms for a meeting or for over an extended period of time for a quarter, and because I'm going to guarantee you a large number of guest rooms, I want a discount. And we would normally negotiate a discount with that customer, and then we would track the use of that discount. And so if a group meeting came in and they said they needed 100 rooms and they only filled 60, well, the next time they came back, we would probably not give them the same discount. On the other hand, if they filled 90 or 95 or went over their limit of 110 or whatever it happened to be, we would welcome that and certainly give them that discount going forward. So you want to take care of your best customers. So keep the following in mind. Providing discounts or other perks to your best customers. Don't offer your strongest discount to low volume customers or customers that don't have the potential of being high volume. Really offer your best discounts, if you're going to discount at all, to your high volume customers. look also, you may have a high volume customer, but are they paying their bill on time? If it takes 60 or 90 days or even more to collect from those customers, that's a problem for you because they're using you as a credit card. They're using your company as a credit card. And so even if you were to try to charge 1.5% or 2% interest a month, trying to collect that is difficult, but you don't want to extend credit as well as additional discounts to customers. Same thing with customers who dispute a lot of their charges. The paperwork involved in resolving those disputes often is counterproductive to you. And finally, customers who return a large portion of their products they buy. Let's use Puzzle Mania, for example. And a toy store buys 100 puzzles and then wants to return 60 of them because they didn't sell them over the holiday period. You may accept those products back, but if they do this as a regular track record, you should not offer your best perks to them. So what's an example of a perk that isn't going to cost you any money, but will still be an enticement to create a strong customer base? And the example I have here is first in line for available inventory. As we know, there are some situations where we've had supply chain issues, and it's been difficult to get certain products, food items and other items. There's something going on right now with the Panama Canal, where there are 100 ships waiting to cross the Panama Canal in each direction, a total of 100 ships. That is going to slow down some product deliveries to the shelves of our stores. So, your best customers ought to have first availability on the inventory that you have in stock. That isn't going to cost you anything, and you're going to take care of your best customers at the same time. There are other examples of perks to your best customers that really either are no cost or will cost very little. Another example is if you have certain business hours, you may choose to open early for your best customers or stay open late for your best customers. One of the examples of that is a home remodeling center where designers can bring in their customers at, let's say, 6, 7, 8 o'clock in the evening, because those people are working during the day. You can stay open extra hours for your best customers so that they can bring in their customers, or they can come and shop in your business at times that are convenient to them, and they will appreciate that. John, the next slide. Okay. Let's just move ahead. Okay, build a defendable fort first. This is a really good tactic. And what I'm really saying here is when you start your business, start small, identify your customer base, identify what your customer base is really interested in, and then go after that first. I have a very good friend who actually owns and operates 6 different businesses. And his approach to this is he always starts very small and then builds the business based on profitability and based on customer demand. And he calls that a defendable fort. Interestingly enough, at one time I also worked for Nestle, and they have the exact same approach. And the best example I can give you of that is lean cuisine. When Nestle brought out lean cuisine in the mid-1970s, they didn't take it nationally. They took certain specific markets and tested the product with about a dozen lean cuisine variations. Today they have like 40 or 50 different lean cuisine type products, but they started out very small in specific markets with specific products, and they ran that test for, depending on the market, for up to a year. And then they expanded and took it nationwide, taking into consideration some regional variances in tastes and preferences. So build a defendable fort first, and create the customer loyalty. As you do that, you will improve your profitability that way and ensure your profitability long term. Test your idea with customers. If you want to bring on a new product, talk to your customers about bringing it on. Maybe what you do is that test product or test service, you may offer at a slight discount just to attract attention on that. But be careful, you don't want to lose money on that if you can avoid it. But test a new product or a new service with your customers, talk to them about it. Find out if it's of interest to them even before you introduce it. So for example, in the case of Lulus, one of the things that she might do is add spa services onto her store. Well, before she did that and went out and hired spa professionals, she ought to talk to her customers to find out if they're interested in doing that. Okay, minimize your investment until you know you have a market for the product and service. Do a competitive survey. Find out what your competitors are doing. A lot of that you can find out just by going to their websites. In some cases, it may take a personal visit, and you don't necessarily have to do that in the local market. For example, I have a client who opened a unique wine bar in November of last year, and there are some competitors in her area. She didn't look at direct competitors in her area. She knew who they were, and she knew what they were doing. But for her concept, she went to similar types of operations in Cincinnati, Columbus, Toledo, Pittsburgh, and Detroit. And she saw what they were doing. And she talked to the owners there on what was working for them and what wasn't working for them. And then she came back and talked to potential customers here to find out if there was a market, and sure enough, there was. And so she has brought out a unique product against a number of typical kinds of wine bars in the Cleveland area, and she's been successful. And then finally, think outside the box, but be cautious. You don't necessarily have to repeat what your competitors are, or do something so unusual that there really isn't any market for it. But be unique. Maybe it's doing unique advertising. And to me, a great example of that, if any of you have seen the Subaru ads with the golden retrievers, that is thinking outside the box from a advertising point of view. And it certainly attracts people. I love those ads. It certainly attracts people to see what your product or your service is going to be, and that's an approach. And a good question on this is, what is thinking outside the box to you, and how do you build a defendable fort, or do you have a defendable fort already? So those are questions that you can ask yourself. And get yourself prepared for the next step. John? Another approach is to reduce your fixed costs. You may be able to renegotiate your lease, for example. If you have a 3-year lease or a 5-year lease, there may be some strategies you can use with the lessor to improve your profitability. For example, you may go to the lessor and say, I've got a year left on my lease. Why don't we extend that for 3 more years? And instead of you doing the provision in the lease that says that you can increase my rent the next time I renew by 3% or 5% or whatever, if I do it now, don't give me a lease increase at all. I'm guaranteeing you occupancy in that space for a longer period of time. The trade-off is you agree to waive any rent increases over the renewed lease period. That would be one negotiating position. And so there are always things that you might be able to do. If you have a triple net lease, what you may be able to do is have the landlord take over, for example, the maintenance of the building. In a triple net lease, you are responsible for the maintenance on your part of the building. You may be able to negotiate that back to the landlord, or maybe trash removal, negotiate that back to the landlord. So there are strategies to use. Be sure that you're taking all your tax credits. Have accurate depreciation, have accurate amortization, and these are accounting concepts that you should talk about with your accountant. A lot of people take depreciation, but they really don't do much with amortization because they're not tracking their pre-opening costs. And pre-opening costs can be written off, which is amortization, over a short period of time. And so work with your accountant, keep all your receipts, track all your pre-opening costs, and there are other things that can be amortized as well, but especially those, keep those in mind. And then if you have a home business and you're working out of, let's say, a bedroom, you can legitimately, under most circumstances, take a percentage of your mortgage payment and call it a business expense. Same thing with the cell phone, same thing with the car. As long as you're tracking the portion of business that you're doing with your car, with your cell phone, whatever it happens to be, they can be legitimate business expenses. Again, work with your accountant on that to verify the cost. The last thing you want to do is get an audit. Consider lowering the cost of your suppliers. You should constantly be out there in the marketplace. If you're just using supplies and offer a service, or if you have a product that you're selling, verify continuing costs with your suppliers. 1 week you may go to Staples, the next week you may go to another supplier for your office supplies. I can tell you, in the restaurant business, every chef, every store manager checks pricing with 3, 4, 5 different restaurant suppliers every week or every 2 weeks to see who has the most competitive prices on the items that they sell. And then finally, you see this on television a lot in insurance, and it does make sense, but there are other applications for it as well, such as internet and telephone, TV, and that is the concept of bundling. The more you give business to a supplier, the more they are likely to give you discounts on that service. And it's basically the same concept that we talked about in a previous slide. It's just putting as much as you can without sacrificing your services or your products to a supplier, and negotiating the lowest possible cost with that supplier. John, and then finally, the question to think about is, what fixed costs are negotiable in your business, and can you renegotiate fixed costs before they are renewed? And in a lot of cases, the answer to that is yes. And John, I think that's, oh, one more question. How would you verify comparable value when researching lower cost customers? Well, you want to buy some of their product compared to what you're doing. If there's a shelf life to that product, you want to know what the shelf life is and compare the two, what you currently have and what you are considering, and also verify the availability of the product. Some suppliers may offer you a great deal to start with, but then when you go to reorder, you find out, well, they have to order it from Mexico, or they have to order it from Europe or China or wherever it happens to be, and it's going to be 2 months until you get it. It just happened to be that they had it in stock to begin with, and that's why they gave you a good deal. So you really need to ask those kinds of questions.
Okay, thank you, Richard. So far we've been talking about good things, about growth and investing in things to grow businesses, but sometimes bad things happen too. So we're going to return to Lulu's beauty shop, and let's say there's a flood hits her shop and damages, there's about $100,000 in damage. She has a line of credit, so she can cover it. She's got to withdraw against that, but the interest rate's 7.25%. And so that's going to be somewhere in the neighborhood of $600 a month in interest. Plus, she wants to pay back the principal so she doesn't keep paying the interest forever. And she doesn't have flood insurance, which a lot of people don't. So how might this affect her cash flow? So going back, a slight revision, the cash flow report we looked at earlier. The numbers are the same until you get to March, and then all of a sudden the cash in is more than 100,000 for the first time. That would be the draw off the line of credit, 100,000 plus 48,000 coming in. Likewise, the cash out is 134,000. Again, the 100,000 spent to repair the damage, and then the normal 34,000. I did this for simplicity, kept a nice round number. Obviously, repairs in real life take some time to do, and the expenses drag out, usually odd numbers. However, for simplicity, you can see both these numbers went out. She took in more than she left out, but in the subsequent months, she's paying out the $1,000 expense. She's got to pay that back. So subsequent months, she's got still a little over $600 in interest, plus she's paying back $2,000 a month for about 4 years to get that line of credit paid off, so she can use it again in case there's another disaster. Especially, maybe she needs to buy some flood insurance too. Now, in this case, her shop is unsinkable. I mean, her cash flow, the numbers keep going up, which is nice, but they're not as high as they would have been. They're smaller than they were in the original one. So, and in some situations, if you had a situation like Puzzle Mania, where it's seasonal and you hit some really low points, you can see this could sink the business. So this is an example of a bad thing that happens. And one of the ways of coping is with a cash line of credit. Another is to have a cash reserve, but again, you don't have that reserve to work with while you're paying it back. So this is just another example of how setbacks, you can use your data to help make decisions. Can you afford to keep going, and do you have an adequate reserve? Another situation in the times of recent years where we saw supply chain interruptions, and as Richard said, even now we've got something going on with the Panama Canal. So supply chain interruptions aren't necessarily over. But Fred, who's the owner of Puzzle Mania, has been having trouble getting fiberboard deliveries on time. And again, whether fiberboard's stuck in the canal or whether what's going on, they got to look for other suppliers. They got to figure out some way around it, find an equivalent product that's on time. May need to buy some stuff ahead. Get some facilities to store fiberboard, and that material has to be moisture controlled. It's got to be climate controlled. You've got to have some heating. You've got to have some lighting so when you go in and draw from the stock room, you can see where you're going. So there are some expenses. So what kinds of costs might increase in this case? How much? You can make a guess if you want. You throw any thoughts into the chat box. But think a little bit about if you were hit with a supply chain interruption, you had an opportunity to buy some material ahead. Maybe you had to buy larger lots than what the normal supplier does. How would you deal with that? Have options. So again, throw some thoughts in the chat box on what you would do in that situation. So another kind of setback has to do with obstacles. We talked earlier on in our first session about how data collection analysis is important. It does take time and money to do it, but it's vital for the survival and growth of the business. But in this case, each of the businesses have a setback. In the case of Puzzle Mania, Fred relied on the accountant of many years to keep the books for Puzzle Mania, prepare taxes, help them get good decision support data. But she used her own system, which no one else understood. And one day she resigned suddenly and moved out of town. So he's kind of stuck. Hopefully she didn't take some of the treasury with her too. but you got to think about that. In the case of Lulu, she had an automated software product. She didn't have an accountant, but she had a nice software product to manage her shop finances. Suddenly the software company went out of business. There's no customer support. And it's a system that requires a part. And how's she going to regain some capability? So think about in your situation, throw it in the chat box, or we can talk about it at the end when we open up for everybody. And how would you deal with it with a situation where suddenly your data collection analysis effort isn't working? And people often do that. They will instead of paying for an accountant, sometimes they'll have friends do their bookkeeping department. And then if the friend falling out or the friend goes away or something. I've seen businesses suddenly in real trouble because they have no records and no way to reconstruct it because nobody knows how to do it. They've not been in close contact with them. So think about that. Also, think about how Fred and Lulu might have prevented this problem in the first place. And again, that's even better if you have an accounting system you understand. You've been personally involved in it. It's a lot easier to recover from it. So now I would like to open it up to the chat box. And Richard, if you can open up the microphones too, looks like we've got about 17 people here, so I think we can manage it. So if you want to open up the microphones, we'd like to just encourage some open discussion to the extent you feel comfortable sharing your business's experience. But yeah, if you've encountered any of these kind of situations, something similar, and if so, how did you use your financial data to make decisions, especially when your marketplace changes? How do you use that to cope? Any examples, ideas? We'd love to hear. I think everybody would like to hear. Certainly nothing sensitive. You don't have to bring any proprietary data into the discussion, but we would like to open it up for everybody. So, any thoughts? I don't see anything in the Q&A box. This chat box has some remarks. Any experiences? Is this something that we made these things up? Did we have other businesses? Your businesses had similar experiences? And do you have any other questions then? I'll just open up for general questions. I hope we didn't put you all to sleep, but anyway, we've enjoyed doing this presentation. I hope you've got some insights and able to also have something in the Q&A box just popped in. A good source. I don't have personal experience. Here we go. Personal experience. Richard or Chris, do either of you have any insight into QuickBooks? We can't endorse any particular product, but we can give you any insights we have or anything that we've heard.
Yeah, I've got a little bit of experience with QuickBooks. There are actually several good products on the market. QuickBooks is probably the best known, but there's another product called FreshBooks, which is less sophisticated than QuickBooks. It's really designed for very small businesses. QuickBooks Now and FreshBooks are all cloud-based. I don't think you can buy a copy of QuickBooks today that is not cloud-based. For those are really good PC applications. There is a similar product called Xero for Apple, and that's an opportunity as well. As John said, we don't endorse any particular product, but if you set up any of these products, QuickBooks, FreshBooks, Xero, there may be a couple others out there with the chart of accounts for your industry, and that's really important that you have a copy of the chart of accounts for your industry, and your accountant knows how to get that. Most trade associations are responsible for that. So if you belong to a trade association, or if your accountant knows how to contact that trade association, they can get a copy of the uniform system of accounts for your industry, and that's what you're looking for, the uniform system of accounts. You plug that in to whatever accounting system you have, and it should work pretty well, because that uniform system of accounts will structure all your financial data for you. And just about every accounting system out there can handle that as well. And then LaShawn, I will contact our administrative assistant and ask her to send you a copy of the first session as well.
Right, and I think the recordings are available. I think chapter still putting up those up on the website, or they're on our Facebook account.
Yeah, everybody's going to get a copy of this slide deck and the link to this presentation as well.
Yeah, and the previous one, I think it might be available on the Facebook page for chapter 2.
Both this session and the previous session are all available on our YouTube channel.
Okay.
Chris,
Victoria,
Victoria just asked a question. I am starting out. I am funding all my supplies. Do I start my cash flow sheet with the balance of that cost? Chris?
So I would say you definitely want to keep track. All of your expenses are going to be tallied up against your revenue at the end of the year. So you're going to want to, if you're going to start getting your cash flow, you're going to want to sort of project how much are you going to need to purchase every month, and you're going to try and guess how much sales or revenue are you going to have every month. So there's a variety of things, but yes, you definitely want to keep track of all of your expenses, because that will come off against your revenue, so that you're, deducting everything that you can to pay as little taxes as you can. So yeah, cash flow is going to be what you're putting in now. And I don't know if John or Richard, you want to speak to this, but you can write that as basically a loan to the business that you're putting in for yourself, so that when you do have profits, you can pay that money back to yourself, and not have to pay income tax on that, because that's an expense that is going to be deducted. So again, it's a great question. It's something to work through. How do you do that? You'll want to set up with your accountant, but for sure, at a minimum, keep track of all of your expenses, and know all of the money that you've put in. I think the easiest way, and I tell this to everyone, make sure when you're starting a business to set up a completely separate bank account and set up a separate credit card, so that you're not going line item by line item in your personal accounts and what is personal and what is business, and highlighting and trying to figure it out. So best case, like the cleanest, easiest way, if you have the savings for it, set up a business account, put in a lump sum of money. That'll be, the loan that you're going to give to the business to get started. And then all of your expenses will either be coming out through a credit card or through direct pay through your bank account, or however you're going to do that. So yes, that's a great question. And again, the cash flow, especially if you're just starting out, is going to be a lot of guesswork, but it's still good to have an idea of roughly what you expect to see in expenses, and roughly what you're going to expect for revenue will help you work through, how much, what's called working capital, how much money you're going to need to get it off the ground.
I agree. Yeah. Those one-time startup costs, and Richard, you'd mentioned it too about amortizing them. We didn't go into amortizing some of the fine points of accounting in this session, but basically, your one-time startup costs and in a real profit, actually show up more in a profit loss statement than it will in a cash flow sheet. The money you paid out of pocket to get the business off the ground, as Chris said, is really a loan from you to the business. And on your profit loss sheet, in those fixed expenses, you can actually put a line for amortization. In other words, paying yourself, business paying you back those one-time startup costs, and that does then affect your taxes, because that adds to your fixed expenses and brings down your profit that you have to declare for tax purposes. So yeah, but that shows up more on the profit and loss side than it does the cash flow sheet.
Right.
Okay.
The important, I think one of the important points of clarification here is that the cash flow statement really talks about cash only. It's cash in and cash out. So in your case, Victoria, you're starting with a certain amount of money cash in with the business, and that's your starting balance. And then you're paying for your supplies out of that. And that's the way it needs to be recorded, that you're putting in $1,000, $500, whatever the initial amount is, into the business. And again, as John and Chris have both said, it can be a loan to the business. And then you're paying for your supplies out of that initial cash, and it'll be reflected on the cash statement, the cash flow statement, and it will also be reflected on the profit and loss, the income statement as well. And you also had a follow-up question. I wanted to introduce my business by reveal, and I was going to offer sample bags. Is this a good idea financially? Chris or John?
Yeah, I think the answer is going to be it depends. And again, as you saw the numbers, how Chris showed you how to work the numbers, this would be basically a lot like the coupon. It's not exactly a coupon, but your business is going to be incurring an expense. And again, if you capture that expense, estimate what it's going to get for you, run the numbers the way Chris showed you, you'll get an idea of whether it's a good idea or not.
So I always like, when I'm testing something new, to start small and see what the return is. So let's say if you want to make bags, could you start with, I don't know what the cost per bag is, but let's say you start with 20 and you get 2 people that are interested. You have a 10% response rate to that, and what are the sales off of that? And then you could say, well, if I did 20 and I got 10%, if I do 400 and I'll get 40 new sales or customers or clients. So start with something that's small. It has to be statistically significant. You can't do like 3, and if no one responds, say it didn't work. So it needs to be a big enough sample that you can see what the response and the return is. And again, test things in small ways, see what the response is. And when you find something that works, now you can scale it and do it more and more and more. Yeah.
Let me give you an example of something. I have a client that opened a unique beverage store, and I'm not talking about the wine shop. This is somebody else. They're offering a unique beverage to the community, and there's nothing like it in the area. And so what they did was they started out by offering 2-for-1s. It still allowed them to maintain a small profit margin, but it attracted people to come in and not only one customer at a time, but two or more customers at a time, and socialize in their store, and build the business that way. They were starting small, but they were offering something to introduce the product that was unique to the area, and it's worked out pretty well for them.
Okay. Any other
That
questions?
looks like it's it.
Okay, and thank all of you for the gracious comments you left in the chat box as well, and got a chance to look at those. So thank you all for your kind attention, and I hope this was helpful. And yeah, you'll get a copy of the slides and as well as a recording of the presentation. And so good luck to everybody, and have a good night.
Thank you. Bye.